All right, guys, we are live here today. I'm going to tell you the dramatic truth of buying a house in Tuscaloosa right now due to inflation. You're probably hearing a lot of things, in the media right now, probably seeing things online about how bad the real estate market is. What we want to do on this video today is tell you the truth. There is some good, there is some bad. We want to be honest with you and let you make that decision. But we just want to give you the right information. So, we still have a lot of people looking to move here to the Tuscaloosa, Alabama market. We have people asking if they should rent or if they should buy. Prices have definitely gone up. We've seen a lot of people moving here, and it's just starting to get a little bit less affordable for them to do so, particularly first-time home buyers. But we want you to know there's some amazing loan programs out there for people right now with adjustable rate mortgages, and that term scares a lot of people because of what happened back in 2008. But it's a lot different today. They're not anything to really be worried about. In fact, I've purchased a house myself with an adjustable rate mortgage. So if you know how the game works, it's not quite as scary. So we're just here to set the record straight, tell you the truth, and tell you what it's like to buy in today's current market. And by the way, if you're watching this, particularly on YouTube, if you got some questions about buying in the Tuscaloosa market, feel free to call, text, email if you got questions and you need some help moving to the area. We'd love to reach out and get a chance to talk with you. So my friend Dan Cook is on here today from Mortgage Right. He's a great mortgage professional who works with us very closely in the Tuscaloosa market. I'm going to be asking some questions of him since he's really the true expert on these programs. So Dan, when it comes to a purchase price of $300K, what are these clients looking at as far as issues, and what are some of the programs out there to help them with some of the issues in today's market?
You had mentioned the adjustable rates, and I know that is a big topic right now. And a lot of people are truly scared of that. The first thing that you hear about 2008 crash and everything is everybody had an arm, and that's what happened. Is that true? Yes, but it's not the full truth there. A lot of the arms around that time were really attached to a balloon payment, and that was a big part of it. And if everybody hadn't been in arms, would we still gone through? Yeah, because there was a ton of other factors in that time frame that caused the crash. Then the biggest difference now is really in regulation. There are most everything that was allowed back then is not allowed right now.
Yeah, thank goodness, right?
Big difference. So when you mention the arms, and I know that's something that people are interested in or hearing, and it's coming back there for a while. Most banks wouldn't even offer it because it was a risky product. It is coming back, and it is more regulated now. What I encourage you to look at, if it saves you a little money, is it the best thing to do? Maybe not. It depends on where you're looking at, what the time frame is of what you're going to be doing with that home, and what the costs are up front. And when you make a change, modify your mortgage, what those total costs are, to see if it's the right move for you.
Yeah, there definitely are some guidelines in place. Back then, people's interest rate was going from 3% year one to like 12%, year three. There's rules and regulations in now that, and correct me if I'm wrong, Dan, but I believe all adjustable rate mortgages right now can only go up a maximum of 2% from whatever the original loan is, regardless of the index. Correct? So you're only going to go up or down 2%.
There's caps on how much a loan can increase.
Yeah. And so, if adjustable rates, scare you, and that's your own decision to make, do your own research on it. There's also another thing out there right now in the market that we're seeing a lot of people doing, called a temporary buy down. And Dan, you can correct me if I'm wrong on this, but the way a temporary buy down works, just to make the numbers, simple here, if you're looking to buy a $300,000 house, and the interest rate is 7%, which is, here at the beginning of November is, give or take where interest rates are right now. What you can actually do, the seller can actually pay for a temporary buy down, which would buy down the interest rate from 7% to 5% for year one, which is going to be about $300 a month you're going to save. Year two, it goes up to 6%, which would be a savings of $150 a month. And then at the beginning of year three, it would go to the rate of 7%. And so on that one, you are getting a fixed rate product. You're just getting a lower rate for those first 2 years. And so you're saving $300 a month for year one, which is $3,600. Year two, you're saving $150 a month, which is $1,800. So you put those two numbers together, you're saving about $5,500. And what you would do, that you as the buyer cannot buy that down. The seller, or in a lot of cases, what we're seeing right now, the builder is just paying that into the settlement cost, and they're paying that just like they would pay like your closing cost. So the bank is still getting that extra money. Just the seller is giving them that extra money that you're not having to pay in the payment. They're giving that to the bank right up front on closing day. And what you're essentially doing as a buyer is you are betting on the market going back down and interest rates coming back down. And during that 2-year period, refinancing back at a 4% or a 5%, or maybe, even below that, kind of rate. So just know that's what, if you hear, negotiating discount points, buy down points, that's kind of what's going on in the market right now. Did I get that right, Dan?
Yes, you did. You did. You hit the perfect part on that. That this is a 30-year fix. This isn't the adjustable rate. So it is an adjustable rate, I suppose, but it is a different product than what you're thinking if you're talking about the traditional ARMs.
Yeah, it's going to adjust to a predetermined schedule. It's not going to be based on a market index or anything like that. It's going to be set in stone the minute you sign the paperwork.
And you're still qualifying off of that original note. So that's where everything is. Yeah. But you're getting the benefit of a lower payment in year one, year two, if you're doing the 2-1 or there's a 1-0 where it's just the first year and it's a point off the interest rate there. There's a few different options to look at in there. And for somebody like me that's at Mortgage Right, we even have in our product, if let's suppose you decide that you do the 2-year buy down. If you're refinancing in a year, where does that prepayment of the interest go? Well, it goes back to the borrower with ours. So it's not throwing away money if you do something a little earlier than maybe what you intended to do there.
Yeah, one thing to consider, and my favorite niche right now for buyers, if you're really looking to get a good deal on a house right now, is new construction. Houses are sitting, the inventory is going up. So for a long time, the past 2 years, we didn't have any inventory on the market. And as soon as a good house would hit the market, it was like just a mad dash, multiple offers, people putting in offers, $20,000, $30,000, $50,000 or more above list price. And in a lot of cases, they weren't even looking at the house. They were just, they knew they were relocating to the area. And so they were kind of watching from afar, and maybe their agent did like a video walkthrough of the house, and people were writing offers, on properties they've maybe never even been in, or maybe it's not exactly what they wanted, but they were just in a mad dash. Right now, inventory is up. The number of months on the market is up, and it's up, pretty substantially compared to what it was a year ago. And the thing to realize, and this is what buyers need to know in this market right now, it's the inventory is rising because buyers are pulling out of the marketplace altogether. They're just saying, listen, when I was at 3.5%, I could afford a $300,000 house. Now that it's at 7%, I can't. So there's a little bit of like false inflation of inventory right now. It's not because we have tons of extra listings hitting the market. It's just that the amount of buyers who are out there actually looking to actively buy have gone down. A lot of them have just decided, hey, I wanted to sell my house. I wanted to relocate to the area. I want to buy a bigger house, I want to buy a smaller house. But now, because of where the market is with interest rates, I'm just going to simply stay put. And so what's happening is that builders, they were building houses, they were selling them before they even poured the concrete. Now those houses are sitting there. And so you're starting to see builders come off of the price of the house. You're starting to see them adding, appliance packages and better warranties. And you're starting to see them, offering these temporary buy downs. I would tell you, though, you have a lot of power right now as a buyer to negotiate, whereas you didn't just a couple months ago. But if you're going to get a seller, whether they're a builder or not, to pay these buy down points, just know that's going to also affect how much that seller or that builder can pay towards your closing cost. So on a FHA or a VA or a USDA loan, builders can pay more of your closing cost. If you're going with a conventional loan product, they can't pay quite as much. And so if you're asking them to pay all of your closing cost, which right now they're willing to do, they weren't a couple months ago. Right now they'll pay all your closing costs. They'll deliver a Starbucks to your office, and they'll take you on a limousine tour of the city just to get you to buy the house. We got a lot more power, but when it comes to writing your offer and how much you're going to ask the seller to pay of your closing costs, if you're going to do these temporary buy downs, you just have to know how that factors in to the overall closing costs that they are allowed to pay. So just be aware of that as well if you're going with the temporary buy down. That's why more people are going the route of going the adjustable rate and just getting the seller to pay all the closing cost instead of the builder paying part of the buy down, but then you as the buyer still having to pay for for the rest of the closing cost or the buy down points. So, miss anything on that, Dan? That's kind of what we're seeing on our end.
Yeah, that's pretty accurate there as well. I will mention on conventional loans, depending on how much money you're putting down, sometimes you can get a little bit of an adjustment there for the closing costs that can be covered. But it's always important to make sure that when you're talking to somebody and you're doing a loan with somebody, make sure you're getting all of the information and working with somebody that's knowledgeable and knows kind of the extra rules or the little things here and there. Best thing that you can do is take a look at not just one option, but look at many. A lot of the builders, if they've got their own financing or they're doing their own buy downs, there's other lenders out there that are capable of doing these buy downs too. And you can kind of get out from under their umbrella and see a second opinion and see, am I really getting it best from there or over here? Is this the better way to go?
Yeah, absolutely. What you got to realize, these builders and the listing agents that are listing these properties, they're trying to market their property as good as they can. And so, are they offering these temporary buy downs right now? Yes, but just like Dan's saying, there's not a one size fits all on these temporary buy down loan programs. So, are they offering a really good one? I don't. You don't know unless you compare it to another buy down program. So if you go look at, if you want to look at some new construction houses, or you're looking at some listings where they're offering a temporary buy down, you owe it to yourself to look at other options, because that buy down program they're offering, maybe it's a good product, or maybe it's just a product they felt like they could market the best. Maybe they felt like they could just say they're doing a temporary buy down, but maybe it's not as good as others. So you owe it to yourself to reach out to a mortgage professional like Dan, just to make sure you're getting, the best option when it comes to, that loan program that you're going to take on. Here's another thing I want people to realize as well, where the market is today. I mean, inventory is up, not as many people are buying. Sellers are, like I said, are begging you to write offers right now, so they can sell. So think about this, are you really better off? And this is something we're seeing. I went through our MLS hot sheet that has a list of all the houses that have closed like in the last 7 days. The vast majority of those properties sold for below what the listing price was, and a lot of those were after 1 or 2 or 3 price reductions. So there's one neighborhood in particular that I can think of where the prices in that neighborhood, in April and May, were trending to $500,000 or more, which is a lot for a subdivision in Northport. Are you better off buying the house at 500,000? Excuse me, it's listed for 500,000. Are you better off getting to a bidding war and ending up at 525 on the property with a lower interest rate? Or would you be better off today being able to shop around a little bit, not having to make a rush decision, being able to sleep on it, being able to compare other options, being able to negotiate? And one in particular I saw ended up, it probably would have been in the low 500s back in March and April. Ended up, after a couple price reductions, ending up in the mid 400s, like 459. Are you better off at 459, even with today's higher interest rates? Maybe paying over the course of 2 or 3 years, maybe paying $10,000 in higher interest versus getting yourself into the bidding war market that we just came out of and paying a lower interest rate, but having to pay $20,000 or $30,000 more, on that property. If interest rates go back down like we think, and I bought my house in a time where, interest rates were higher. To me, I'm better off as a buyer when I have power in the negotiations, and I feel like I can negotiate that price down to a point where the payment makes a little bit more sense. But even if I'm having to pay a little bit more in interest for 1 year, 2 year, 3 years, I'm still getting that house for way less than I would have if I would have bought it during the bidding war kind of market. And I can always refinance that property when and if the interest rates, kind of go back down. So
Absolutely. You can change your interest rate at some course over the loan. What you can't change is what you bought that house for. So
that's
it's
right.
big.
Yeah. No, yeah. If I bought the house for 459, I can always refinance and get a lower rate. But if I bought that thing at 515, I'm always at that higher rate. And if I wanted to move, if I wanted to sell, put a sign in my yard and move to another city, that's $50,000 less that I'm going to walk away with just because I bought it in a crazy bidding war market. So to me, I'm back in full buy mode. Some of you that watch my videos, that I'm a real estate investor as well. We right now as buyers in the market have power. So if you're looking at moving to the Tuscaloosa area, or you're already in Tuscaloosa, you're looking to buy a bigger house or buy a smaller house, it's not that bad right now. There's a lot worse things that could be happening. And, at the end of the day, you can negotiate right now. You can get the seller to pay for more stuff, and you can get them to actually repair the house, where that's kind of coming back now. For about 2 years. Sellers were like, I'm not paying you into closing costs. I'm not fixing anything on the house. You either like it or love it, or, like it or take it. If you don't like it, I'm just going to put it back on the market and I'll find another buyer in 24 hours. Right now, houses are sitting on the market for 30, 60, 90 days, and they're just looking for one offer. And when that one offer comes in, if they're a smart seller right now, they know I might not get another offer for another 30, 60, 90 days if I even get an offer at all. So when an offer comes in, if they've got a smart agent and they are a smart seller, they're trying everything they can do right now to get that property sold if they're truly motivated. So as a buyer right now, it's not all that bad. So which market would you rather buy in? The massive bidding war. We literally had people over the last couple of years that we did video chats with who were in other states, and they were writing full price, above full price offers, knowing that they were going to have multiple offers compete against on properties they didn't even really like. They weren't exactly what they were looking for. And about 70% of people that were surveyed who bought during that time said they regretted buying the house they did at the price that they did. So would you rather buy in that market, or would you rather have a little bit of time to think about it, a little bit of power to negotiate, a little bit of power to even negotiate that temporary buy down of your rate? It's up to you. We're not here to sell you one way or the other. Our job on here and making this video today was really just to give you advice. And, we can't help you if you don't reach out. So if you're on here, you're thinking about moving to Tuscaloosa area, or you're thinking about buying another house in Tuscaloosa, please reach out to us. We can't help you if you don't reach out, and would love to help you with some true, honest advice about what's going on in the market and help you create a strategy that works best for you. Dan, are we missing anything?
That's pretty good. I think you're right about that. And if I can help anybody, I'm more than happy to. My philosophy is everything just starts with a conversation, and we can keep it at that, or we can progress and go further. But let's just start with a conversation and see what options are, and let me help you get in the best spot.
Yeah. Second opinions are free. We're happy to give second opinions or third opinions. We're happy of just being your backup plan if you've got another plan in place. But honestly, in today's market, there's a lot of scary things going on in the media. There's a lot of people trying to scare people into making decisions. There's a lot of bad information out there. You owe it to yourself to reach out and get a second opinion or a third opinion. And we just want to be that backup plan for you. So our contact info is easy to find. You can see it in the comments down below. Second opinions are free. It never hurts to have a backup plan. Thank you guys for hopping on here with us today, and I hope this video was helpful for you.